Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. With questions still not answered about the course of inflation in the United States, the Federal Reserve chose yesterday to keep rates on hold. Chairman Jerome Powell says he is comfortable enough with the economic growth and labor stories to stick with his policy of no sudden movements. However, a potential bite from tariffs still to come is there, and a labor market showing continuing jobless claims at pretty steady levels. With these two, how long can this rate position grind on for? And how does the interest rate differential globally leave Canadians who are investing their loonies? We are pleased today to be hearing the perspective of Fidelity's global asset allocation team with institutional portfolio manager Ilan Kolet. Hi, Ilan. Welcome. Good to see you. Where are you?
Hi, I'm very nice to see you, Pamela. Thanks so much for the invite. Great to be here. I'm actually in Boston. I got here yesterday for the retirement reception for our CIO, Jeff Stein, who had a 30-year career at Fidelity and retires at the end of this month. So I was very pleased to be here with my colleagues, David Wolf and David Tulk, to share in the festivities and roast him a little.
He was often on the big stage with the three of you. I remember in various conversations. A brilliant man. So, well, isn't that nice that you're there to celebrate him?
He'll be missed.
I bet he will. Well, I wonder what his thoughts and your thoughts are on the decision yesterday to do nothing. We were looking for words, and you ahead of time had said that you expected Jay Powell to say basically as little as possible and to rock the boat as little as possible with any of his comments. Is that pretty much what happened?
I would think so. Yeah, I think that's entirely accurate. I mean, the way I would think about what was discussed is, the way I'm thinking about monetary policy and the path of monetary policy right now is with the phrase "ready to react." Right. So that's a phrase I didn't come up with. That's a phrase I think I stole from Governor Tiff Macklem from the Bank of Canada, but it's something that's really permeated through a lot of central bank discussion. And I took some notes. Chair Powell used language like the labor market remains solid, but there's elevated uncertainty. We're well positioned. Inflation looks stable from a wide set of indicators, right? So he really tried to reiterate that, the unemployment rate is at a very low level, 4.2%, where it's been for some time, or oscillated around that. And inflation is slightly above where they'd like it, but I mean, there's been tremendous improvements in the rate of inflation from just a few years ago. So progress has been made, and they stand ready to react in a full data dependency mode. And to be quite honest, Pamela, I think the Fed would love to be done, right? So I think they would love to be done. Now, they can't really say that because, they have to be ready to react. But, I mean, they'd love to be done.
Okay, that's really interesting. Are all meetings going forward, and I'm kind of talking about July, live? So let's say we get a slew of tariff data or a slew of labor data that's not good. I mean, in any case, and we'll talk about the relationship, obviously, of those two. But is every meeting live? Could we see a July decision? It always seems like July's a little bit of a sleeper.
Yeah, I mean, historically that's been true, but the way I would think about this is every meeting is live, right? To use a phrase that at the time Governor Mark Carney had used was nothing is preordained, right? So every meeting is live, and what central banks do, and this is something we did when I was at the Bank of Canada, or when David Wolf or David Tulk was there as well, is you have a meeting. So we just had the June meeting, and then you have a set of incoming data points, and then you aggregate that data and you update the models and you go through things in a very rigorous and thorough way. And then you update that base case and you arrive at a decision in July, right? So this idea that that July is a flush, I sort of push back on, because if there was very significant signs that the job market was deteriorating very, very rapidly. Now we don't have those signs. Or if there was a sudden and sharp shock that we would observe to, say, consumer spending or capital spending, then July is very, very much live, right? And they stand ready to react, right? So I apologize in advance for saying ready to react 25 times in the next 20 minutes, but it's going to be a phrase that you'll hear often.
Well, sometimes that's how you weave the themes through. In any case, let's talk about the dual mandate, which is well known, but it has just seems to have a slightly different tenor at the moment. And I wonder if you can go into that for us. We've got continuing claims for jobless claims, steady enough to make those who are so inclined have their eyebrows raised a little bit. And then there is the tariff inflation transitory piece of it. Just talk a little bit more about the tightrope that is often walked, but maybe is a little bit trickier now.
Yeah, so I would say, I mean, if you examine the US data, and I still follow it very closely, I follow the US and Canadian data very closely, as we all do, I would sort of divide things into two chunks, the soft and the hard data. And so what does that mean in English? The soft data are things like surveys, right? So if you look at survey-based information, CEO optimism, or then the National Federation of Independent Business, these survey-based measures, they have seen a softening. There's no question there, they have seen a softening. But the hard data, and hard data, think unemployment, inflation, consumer spending, GDP. I'll come back to that one in a second.
Okay.
Those are doing just fine, right? There is a slowing in the rate of hiring on a monthly basis, but that's something that you just naturally expect when the unemployment rate is 4.2%. That's pretty low, right? And that's around where we think the neutral rate is the natural rate for the unemployment rate is. The GDP report that we saw last time, not to get too into the weeds, was unusually negative because of a big surge in imports with businesses trying to get ahead of tariffs.
Right.
But when you look into the details of the GDP report, which us nerds call the National Income and Product Accounts, the NEPAs, to impress your friends
It's
at
a
your
lovely
next party.
ring to it. Yes, the NEPAs.
Yeah,
Okay.
yeah.
Mm-hmm.
The NEPAs is, if you look at consumer spending, capital spending, and you just kind of strip out inventories and government spending, so this private final domestic demand, it's resilient. It looks fine, right? It looks fine. Economists will sweat over second decimal places, but it looks fine. And this is why the Fed would love to take a wait and see approach, right? I mean, because as your question correctly stated, it's not impossible that we see a tension between the two components of that Fed dual mandate, right? So again, the dual mandate means low and stable inflation around 2% and, maximum employment. That's the way to think about it. And you might imagine a case in which, suppose tariffs are introduced and you get an upward shock to inflation, and because of demand, you get a downward shock to growth and an upward shock to the unemployment rate. This is a very challenging scenario for policymakers. And I think Powell, knowing that this was going to be potentially 50% of the questions that reporters ask in the press conference, he actually hit it head on in his remarks in the press conference ahead of time, and actually fielded that exact question in his remarks. I'm happy to get into that as well.
Well, we'll do, because it takes us, I mean, basically that scenario where you have that increased tension between, it spells stagflation essentially, which is where people
Exactly.
don't want to go, but it is, it's one of the scenarios, isn't it?
Exactly. I mean, and so what Chair Powell said was, very logically, they'll examine inflation and call it inflation and unemployment, right? And I'm paraphrasing here a little bit. And what they would do is they would assess the path forward in terms of monetary policy and rates based on deviations of those two things from where they want them to be. So what does that mean? It means, suppose there's a scenario in which tariffs are introduced, like I mentioned, there's a downward shock to growth and an increase in unemployment because of the tariff shock. If the unemployment rate goes from very rapidly from, call it 4.2 to 5.5%, and inflation goes a little bit higher, right? So a slight increase in inflation, but a significant increase in the unemployment rate, you could expect the Fed to ease, because they would try to shore up that kind of shock to the labor market as fast as they can and in a meaningful way, and tolerate sort of some temporary increase in inflation. Alternatively, if you saw a really sharp increase in inflation and not much change to the labor market, you could imagine, a hike in interest rates, or perhaps them not cutting and just remaining where they are, which is already at a somewhat restrictive level. So again, the takeaway from this is nothing is preordained. All meetings are live, and they'll take a data-dependent approach, and they will be the phrase of the week, ready to react.
Yeah, I've already got it. It's the Pavlovian dogs. I've already got it there. It's there. It's sitting there. Right. A little bit, if you would, just more on GDP and really the question of growth. So he essentially said the economic growth story is fine. He said it's fine. Not needing to reissue particular growth forecasts or taking a look at that. I mean, does that align with what you're saying? Do you expect that to be a trickier question soon? I'm kind of looking for your thoughts on recession here, but yeah.
Sure. Yeah. So, and this is actually an important point, something we've discussed. So we put out a paper in the third week of March called Elbows Up. And it discussed a really important and significant change in our view and positioning. And we'll have another thought leadership paper that comes out next week. It's a short one. It's under 1,000 words, and it'll be an interesting read with some good charts. But what we think is happening is, last year, Pamela, if you remember, when you and me were having these discussions, I mean, a lot of the conversation was around U.S. exceptionalism, right? So in every discussion that you and me had, and on stage and across the country with advisors, I was talking about U.S. exceptionalism, right? We were talking about a huge increase in labor force participation from, disabled workers, and female labor force participation at the highest in the history of the data, and blowing up the standard 9-to-5 work week, and an increase in potential growth and productivity. That all changed, right? And now those underpinnings of exceptionalism, the things that made the U.S. exceptional, came under attack, right? And that's sort of what we've seen year to date. And I would say, we continue along that theme in this upcoming thought leadership paper. In terms of a number of important positioning changes. I mean, we've been underweight the U.S. for some time. That's really been helpful. We've been overweight Europe, which has helped to add value. But the other thing is, we used to be, in the past, this is a tricky one to talk about, which is why we wrote a paper, but in the past, when we were underweight the Canadian dollar, it was really an overweight to the U.S. dollar. So, end of last year, we had a minus. We had an 18% underweight to the Canadian dollar, meaning 18% less of, say, the global balance fund was denominated in Canadian assets, and 18% more of it was denominated in the U.S. That has been neutralized, right? So we are no longer outright overweight. We don't have an outright additional overweight to the U.S. dollar, because we think the direction of travel is likely lower for the U.S. dollar.
And some of that has been dispersed into, as you mentioned, European equities, taking a look at Europe, and actually we can talk about other asset classes as well. But to that, and then to what extent are you looking to redeploy some of that in Canada? Or maybe it hasn't happened yet, but just tell us a little bit about your thought process there.
Yeah, so I mean, and this will be described quite nicely in next week's paper, but which is called, I don't know if it's about coming back home. I mean, if I rewind, right? So in 2013, so this is quite a while ago, when David Wolf started on the team, he made the decision to meaningfully underweight Canadian assets.
So this is after the super cycle is over. This is after the financial crisis. We're kind of still in the European debt crisis at that point a bit.
Well, exactly, right? So Canadian assets outperformed the U.S. People forget about this, but Canadian assets outperformed U.S. assets from 2004 to 2014. Now, in 2000, as you just mentioned, which was spot on, Pamela. That corresponded with the commodity super cycle, right? So I was at the Bank of Canada at the time, right? That super cycle was really significant. Canada, in terms of Canadian equities, outperformed the U.S. 2004 to 2014, right? That 10-year period, because of the super cycle, and also the U.S. had a 1 in 100-year financial crisis that led to enormous declines in the U.S. stock market, whereas Canada Canada did okay through the financial crisis. And then 2014 to 2024, the baton was passed, right? So there was a meaningful amount of outperformance from the from U.S. equities versus Canada, right? Because of the growth, the incredible contribution of growth and low rates and the tech sector, and less and not really that commodity super cycle tailwind that we had for the previous 10 years, right? So there's a really great chart in this paper that comes out next week, just showing that baton getting passed. I mean, last year I used to get questions when I was on the road from advisors, saying, why would I own anything but the U.S., right? And it's because, and that's a natural question to ask when the last 10 years have been so unbelievably strong in the U.S. We think that situation has changed, right? And so what have we been doing? We've been buying back Canada, right? So we've been buying back Canada. We don't have an outright overweight yet to Canadian equities, but we have been buying back Canada. It's, the underweight to Canada now is quite small. And the composition of the Canadian dollar underweight is no longer just a US dollar overweight. It's an overweight to the pound, the euro, and the yen, right? So it's changed composition. It's a tough thing to talk about, but it's an important driver of returns in our funds and for Canadian investors.
It's very, very interesting. And to have sort of the home bias, what is interesting here? Interesting to you? I wonder also what's interesting from international investors. Like, what's interesting about Canada right now?
Well, so, one of the things that we highlight is, well, so what has been the problem, right? So let's first discuss the problem. The problem was, there's been a few, but
there's been a few. Yeah, that's right.
There's been a few, but the biggest problem has been productive capital has gone into seriously unproductive sectors, right?
Like
so it's
real
gone
estate?
into like building, like real estate, right? Instead of inventing things or research and development or software or digging stuff out of the ground. Like, I'm being overly simplistic, but like putting up condos is not a long-term sustainable model for growth in terms of boosting productivity and standards of living. Oil and gas capex is 50% lower in 2024 than it was in 2014, right? And capex in general is lower. Sort of between 2014 and 2024, there was a significant sort of decline in productive capital investment in Canada. That's a different story in the U.S., right? The U.S. has seen a huge increase, almost 50% increase in inflation-adjusted capex 2014 to 2024, and that's resulted in the kind of productivity growth that we've observed. So that's what's happened. Lack of productivity, which is a very long-term problem for Canada, and lack of investment into productivity-enhancing sectors. Instead, it's just been condos. A lot of the growth that we've observed has just been a huge explosion in population, right? Like a way outside of sort of norms. I think we've shown that chart before.
Yes.
But that's reversing, right? So that's reversing pretty significantly. But I would say we are somewhat optimistic or around the potential that some of these trends may be changing, right? So there are now proposals for fiscal policy to boost growth, to boost the drivers of long-term growth. We'll see. Again, we'll wait for the shovels to get into the ground, but that's a positive signal. There's other positive signals, and I think some of this has been, Canadians are kind of galvanized, right? And removal of interprovincial trade barriers and fostering trading relationships with other countries. Those are all productive things. And obviously, if tariffs do get resolved, which we're hopeful of, that would be another negative risk removed from the table, or at least diminished.
That's absolutely fascinating. Just to sort of see where some room and some space might be opening up for investment dollars to go in. You, of course, the way you work with the global asset allocation team is you're using the portfolio managers who are investing, in this case, we're talking about Canada, so would be exposed and making their own decisions in those funds that are directed towards Canada. Do you want to just speak to that a little bit, how you sort of up your exposure to them ultimately?
We kind of have two ways to win, right? So what do? We reach across Fidelity in Canada, in the US, where I'm sitting today, and internationally, and we pick every manager in every one of our strategies, right? So no managers are forced upon us. We pick every manager and we assemble a great team. And we believe in a full division of labor, meaning those underlying managers that we use in our strategies, it's their job to beat their benchmarks and follow their own process. We don't dictate to them in any way what sectors or stocks they should be leaning in or out of. We want them to win. If we own them in our funds, they boost the returns of our funds, our fund of funds, and we win. And then the second layer of return enhancement that we can provide over and above our benchmarks is we can lean into asset classes, geographies, styles, sectors, and currencies, right? And so for a long time, for example, all of last year, we were leaning away from Canada, leaning into the US, and leaning away from fixed income into equities. And now the way that we're leaning is we're still leaning slightly away from Canada. It's smaller than it has been in the past. We're leaning away from the US. We're leaning into Europe. We think Europe is galvanizing, and there are signs of that, certainly, in terms of returns and at the company level. We've leaned into inflation protection in terms of gold. That's been a very important and additive position. And the underweight to the Canadian dollar, again, the composition of that has changed. But yeah, that's kind of how I think about that.
What are your thoughts, Ilan, on the idea of stealth quantitative easing in the U.S. Treasuries market? There's been a lot of issuance, we know this, and they're funding a great big debt there. So what do you think about that?
Yeah, so I would say, I mean, I don't think that we're actually seeing this like stealth QE. I think it's made headlines. It has made headlines because it sounds like
it sounds cool,
engaging. Exactly. It sounds engaging and almost provocative.
Yeah.
But stepping back again, what's the Fed's job? The Fed's job is low stable inflation, around 2%, and maximum employment. And I think if you listen and you watch Powell's press conference, I mean, you could probably watch it. You can speed it up a little bit if you want to get through it quicker. I think he's very, very clear on the balance of risks and the direction of policy going forward, right? So the direction of policy going forward is ready to react. Sorry to use it again. That will be kind of their goal in terms of policy setting going forward. I think the other thing I would say here, this isn't one of the questions, but I'll kind of sneak it in. I think people often really focus on the dot plot, right? So the dot plot.
Yeah, I was going to ask you about that. Okay, perfect.
Yeah. So the dot plot is the summary of economic projections, right? These are projections that board members make for key indicators like inflation and unemployment, and both in the near term and the long term. It's unproductive to hyper focus on the dots and the change in the dots, right? Because what it does is it ascribes too much precision to an inherently imprecise art, right? And especially in the face of uncertainty and tariffs and distracting tweets, we have to sort of add some error bands to the potential outcomes. And again, I follow this very, very closely, and we have entire teams working with us, parsing words and thinking about this and really analyzing and interpreting every single speech from every voting and non-voting Fed member. But the way I would think about things going forward is, and I can't remember if we've already discussed this, but you put a route into your GPS, right? And you start driving, and then along the way, it updates and says, oh, a faster route is available, or there's some construction, but you're still on the best route. This is how to think about monetary policy formation going forward. They're using the best information that they have at the time, and they update it with incoming information, and eventually you get to where you need to be, but the route can change.
For sure. While we have a few minutes left here, I want to ask, in light of quite electrifying geopolitical situations, and also just the idea that havens, in terms of currencies, seem to be a little bit up for grabs. And you described some of that and what it's meant to your changing allocation in terms of currencies. But the interest rate differential will come from, countries having this differential for lots of different reasons. The haven status within that and the geopolitical relation to whether you plow your money into the US because it is the safest currency out there or not. I'm just kind of curious how we should be thinking about this. It seems like a new framework of thinking about this is needed, particularly when we are seeing these geopolitical headlines, and you do wonder where do you hide on some level?
Yeah, another great question. I mean, in the past, when people used to ask me, like, is the U.S. going to lose its reserve currency status? This is a question that came up often, especially when they're the BRIC currency union and Chinese invoicing commodities in yuan. The way that we thought about that is it was unlikely to sort of happen in our lifetime, and we have some great charts on that and with IMF data. But the way I think about this now is I don't want to say I was dismissive in the past, but I'm certainly more sympathetic to this question now. But for me, that question really relates to a question that we've discussed on our team and with our researchers, and we'll be continuing to discuss, which is what we're observing in the US a temporary speed bump, or is this a permanent and secular change to the demand for US dollar denominated assets, right? And that's a very difficult question to answer, something we're going to think about deeply and work with our research. But I would say we don't believe that this is just a temporary speed bump. I think there will be meaningful permanent damage to sort of this underpinning of exceptionalism coming under attack. And because of that, we've adjusted the portfolios accordingly in order to not only add value, but preserve those hard-won basis points from a year like last year, right? So this is how we add value in our funds for the medium and long-term investor that uses, the managed solutions, the private investment pools, and our other funds.
Yeah, connected to all of that, should we worry about an oil shock? To what extent should we worry about an oil shock?
Yeah, it's funny. I mean, no matter what job I've had, whether it was at the Bank of Canada or at Bloomberg or now at Fidelity, I've had this albatross of having to think about and forecast oil prices. It's like it's a thankless task, but it's very difficult to do. I mean, what I would say is, a lot of people think, well, if gasoline prices increase. So the way that oil translates for the U.S. consumer, for example, is it turns into becomes gasoline for consumer expenditures and for inflation. Gasoline is a much smaller share of a typical family's average spend than it was, say, 50 years ago, in part because now we consume a lot more services than goods, but also we're not driving those land yachts, that we used to drive in the past, like my parents' old wood-paneled Ford Marquis station wagon. So the fuel consumption has become more efficient. But jokes aside, it's a smaller share of consumer spend, so it doesn't really rock the boat for the consumer like it did 50 years ago. And the other thing is, the U.S. now produces 13 million barrels a day of oil, right? So it's a energy powerhouse. 20 years ago, that was like 5.5, right? So it actually has an offsetting, right? So it has an offsetting effect in terms of the boost that it has to that capex and to that industry. And so this is something I followed closely when I was down in Boston, but I wouldn't be too afraid necessarily of oil prices pushing higher. And for the Fed, they'll always look through oil and gas.
Fantastic. It is wonderful to have a moment with you right after the Fed, too, and just sort of interpret some of this for us. We look forward to your new piece coming out. Just remind us what it's called, or almost called?
It is called On Our Way Home.
Okay.
On Our Way Back Home. Something like that.
It sounds like a song title, but in any case, we shall read that with interest. Ilan Kolet, thank you for joining us from Boston today. Safe travels.
Thanks.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.